Hello everyone, hope you all are doing well. So in today's lecture, we will start IFRS 18, Presentation and Disclosure in Financial Statement. It replaces IAS-1. Previously, we prepared the financial statement as per IAS-1. But from the 2027, we will prepare the statement of financial as per IFRS 18. Before starting the IFRS 18, let me tell you about the major changes. It changes to statement of profit and loss as additional defined totals will provide better consistency. Also, it is introducing disclosure requirement of management performance measurement that will increase the transparency, also strengthening the requirement of aggregating and disaggregating information. Once we read the next content or slides, we will get the better idea. Also, it is about the IAS 7 cash flows. If you remember, in the cash flows, there are three activities: operating, investing, and financing activities. Now, as per IFRS 18, profit and loss will also be further expanded into five categories, such as investing, operating, investing, financing, and after that, we have continued and discontinued operations and taxes. Now, there is one important thing. In the IAS-1, we often use the PBT, profit before tax. But now, from the IFRS 18 implementation, the PBT will change with PBIT, means profit before interest and taxes. Now, in the IAS 7 cash flows, if you guys have studied IAS 7, so you better understand this thing. Then all the components or balances are classified into each of their categories. If any amount spent or received with respect to operating, then the specific amount will goes into operating activities. It gives the better transparency and better idea to the users of the financial statement. As the users does not only relate to shareholders, it is also for the stakeholders, means general users. So for the better understanding and better transparency for the users, now IFRS 18 will further divide the profit and loss account into five categories so that non-financial users or non-financial persons can also get the better idea. Now there are few students who may confuse between IAS 8, IFRS 18 and IAS 1. There is a little change in the title as the title is rechange basis of financial statement or basis of preparation of financial statement. So nothing to worry. IAS 8 changes in accounting estimates, changes in accounting policies, and prior period error is still the same, which you guys have covered in the previous lectures. Today's lecture is all about IFRS 18 and IAS 1, how IFRS 18 will further progress in the upcoming days or months or year. The effective or tentative date of the IFRS 18 implementation is from the Jan 2027. So before starting the IFRS 18 reading, I would like to show you the visuals how IFRS 18 and how the statement of profit and loss will be prepared as per IFRS 18. Okay, there are few visuals in the end of this slide. IFRS 18 requires to improve financial performance. IFRS 18 requires a company or an entity to classify income and expenses into operating, investing, and financing, which will given in the next visual under the dark blue. Categories in the statement of profit or loss plus income taxes and discontinued operations. So now it is categorized into five things. And to present two new defined subtotals. This is management performance measurement. operating profit and profit before financing and income taxes, EBITDA, earning before interest, tax, amortization and depreciation. Now, illustrative statement of profit or loss. Income and taxes from company's main business activities, operations. Income and expenses from additional activities. Additional means, can anyone tell me please? Are also classified in the operating category if there is a condition of if those income and expenses do not meet the requirements to be classified in any of the other categories. It means if there is any income or expenses which category has not yet defined or which is not identified, then that specific income or tax will also be categorized in the operating activity head. Now, categories: operating, investing, financing, then income tax, then discontinued operations. So now we have covered the operating link. Now in the operating, let's see which items come. Revenue, cost of sales, gross profit, other operating income, selling expenses, research and development expenses, general and administrative expenses, goodwill, impairment loss, other operating expenses, and the accumulate is operating profit. Starting point for reporting cash flows from operating activities, IAS 7. Now in the investing, we have share of profit and gains on disposal of associates and joint venture, IAS 28 and IFRS 11. This is how you have to prepare the statement of profit and loss as per IFRS 18. The required subtotals: profit before financing and income taxes. Now in the financing, we have interest expense on borrowings and lease liabilities, interest expense on pension liabilities and provision. Look how IFRS 18 category discloses all the particular information into the relevant head. If you remember in the previous IAS-1, the all interest club into the finance cost. Then in the finance cost breakup, you have to identify either the interest come from the bank charges or from the markup, accrued markup, or other ECL charges. But from the IFRS implementation, it's very easy to understand for the users of the financial statement that this particular interest is from this and that particular head. Now PBIT, profit before income and taxes. These are the main categories. Then we have income taxes. After that, we have profit from continuing operations, loss from discontinued operations. It could be any, depend on the condition. Now for the financing, we have income and expenses on liabilities such as bank loans, overdrafts and bonds, and interest expenses on any other liability, for example, lease and pension liabilities. Means any income or expense on the liabilities or on the debts will come under the financing. Income and expenses from assets that generate returns separately from a company's business activity. There is a word separately from a, that generate returns separately from a company's business activities and from cash and cash equivalents, and investments in associates and JVs will become under the investing activities. Now there is a sample of profit and loss, IAS-1 versus IFRS 18. This is Colgate Palmolive Pakistan Limited statement of profit and loss for a financial year 23 presentation under IAS-1. These visuals have been taken from the PSX site. Now in the IAS-1, we have revenue, sales tax, trade and other discount. Then we have net turnover. Cost of sales, if we minus cost of sales from the revenue, we will get gross profit. Let's see in the category as per IFRS 18. Same revenue, sales tax, same trade, net turnover. But there is a category of operating. All these things are categorized under the operating activity head. Now we have cost of sales. If we less cost of sales from the revenue, we will have gross profit. Now selling and distribution. Here we have selling and distribution, administrative, other expenses, other operating expenses. Please pay attention and identify the keywordings. Other expenses. Now we have other operating expenses, other income, other operating income. In the previous IAS-1, the other income cover any kind of income, means other than ordinary course of business. Now, in the end, we have operating profit as per IFRS 18, but as per IAS-1, we have profit from operations. Now, finance cost and bank charges. Look, the thing which I have discussed earlier. But now, as per IFRS 18, the category is investing in which income from financial assets. If there is an income from the financial asset, then we have to categorize it first before the financing. Then we have taxation in the IAS-1. In the IFRS 18, we have financing in finance cost 150682. Now we have PBT, profit before taxation, income taxes, taxation, profit after tax. If there is discontinued and continued operation, then you should have also incorporated it. So this is the structure and the visuals which I have shown you, and I have explained you why IFRS 18 is better than IAS-1. Let's start reading these slides, then we will get better and clear understanding. Okay, these are the detailed slides for your better understanding. I will read with you few content, but you have to read the remaining for your own understanding. In this slide, I have also explained the real life scenario example. So after reading those case studies, you will get the better clarity how IFRS 18 is implemented as against the IAS-1. IFRS 18 replaces IAS-1. The summary: IFRS 18 is the new global presentation and disclosure standard. It replaces IAS-1. It standardized the income statement, means it structured the income statement into 5 categories, which we have just covered, and requires new subtotals like operating profit and profit before financing and income taxes. It introduced management defined performance measurements such as EBITDA, recurring, such kind of items, with strict note disclosures and reconciliations. Cash flow classification for interest dividend is tightened and must align with how related income expense is classified in profit and loss. Now, for the each item, there should be linking, there should be logical reasoning. Effective annual periods beginning on after 1st Jan 2027. Early adoption allowed. Comparative must be restored. Now, after that, we have why IAS-1 was replaced. Problem with IAS-1. Too much flexibility. How? Inconsistency subtotals. But now from the IFRS 18 implementation, the subtotal should be consistent. Everyone defined operating profit differently. Yes, it was the case. Non-IFRS measures like adjusted EBITDA, earning before interest, tax, depreciation, and amortization were outside the audited financial statement. Of course, hard for the investors to compare, means non-financial persons, non-financial users. Aggregation, heavy set of other lines, limited guidance on what to split out. Now we have scope or and effective date. Applies to all entities reporting under IFRS accounting standards. Effective for annual periods beginning on or after 1st Jan 27. Early adoption permitted. Retrospective means prior year. Comparatives. Retrospective application with restated comparatives provide a reconciliation from previously reported comparative to restated the amounts. Why it is important? Because it gives you the better understanding and the better clarity of the previous year's balances as well. Third, statement of financial position required only if reclassification restatement has a material effect on the opening balance sheet, because opening balances are very, very important. Now, the new statement of profit or loss, which we have covered individuals. Let's go through this one as well. Categories top to bottom order, T to B. Operating, investing, financing, two buckets from financing activities and from cash and cash equivalents. Income taxes, discontinued operations. With these cases A to E, which we will cover in the later slide, you will get a practical 360 walkthrough of IFRS 18 changes, covering profit or loss subtotals, expense presentation, cash flows, goodwill, and MPMs, all with relatable examples. Foreign exchange differences, foreign currency retranslation or differences are presented in the same category as the items that generated them. Means if it's from the if it's from the assets or from the non-current assets or from the liability, then the treatment would be as per them. Now, required subtotals on the face: operating profit, profit before financing, and income taxes, profit or loss. Entities can label total subtotals. Example, use net income instead of profit or loss. This is how the structure will work as per IFRS 18. As long as labels are faithful and not misleading, means it will give the faithful representation. Now, classifying income and expenses rule of thumb. Operating your core business results excluding financing and investing. Investing. Return from investment generating a return individually and largely independent of other resources, such as additional to any new assets or disposal of an asset or dividend from associate. Now, financing, effect of financing activities, interest on borrowing, dividend to NCI, dividend by parent company, unwinding of discount and from cash and cash equivalent. If providing financing to customers or investing in assets is a main business activity, some items otherwise in investing, financing move to operating, which I explained in the start. Share of profit, loss of associates and JVs equity method. We all know if there is a joint venture, then we will use equity method. Is outside operating in investing. The old integral, non-integral split is removed now. Presenting operating expenses. You can present by nature, by function, or a mixed approach, choosing what gives the most useful structured summary. If any operating expenses are by function, such as cost of sales, admin, and selling, provide a single note disclosing totals for 5 specified expenses. By nature, depreciation, amortization, employee benefit IAS-19, impairment losses IAS-36, and write-downs, reversal of inventories IAS-2. Explain the nature of expenses included in each function like qualitative. If you present cost of sales, it must include total inventory expenses as per IAS-2. Now, management defined performance measures. What is an MPM? Might be this time the examiner asked these things. A subtotal of income expenses used in public communication, means outside the scope of IFRS, that supplements IFRS total subtotal. Examples: EBITDA, adjusted operating profit, adjusted EBITDA, core profit, etc. Okay, now, can anyone tell me why the IFRS 18 presentation and structure is more similar to the IAS 7 cash flows? Because I don't know if you guys have talked about any non-financial background person, such as from the IT person or from any engineer or a doctor, that Non-financial background person can easily understand and prepare a basic cash flow statement. You know, if you don't know, just try to communicate this thing with any non-financial background person. Why? Because everything is aligned within their specified category. So it's very easy and very understandable for them to identify and pick all the information or transactions according to their specified category. That's why for the better presentation, faithful representation, consistency, and more objectivity, the IFRS 18 is implemented. Where and how to present MPM in a single note to the financial statement, not as a free form column with undue prominence. For each MPM, disclose definition why it's useful. Reconciliation to the most directly comparable IFRS subtotal operating profit or profit before financing and income taxes. PBIT. Tax and non-controlling interest effects of each reconciling item or how you computed them, consistency over time, explain any changes in defining calculation or discontinuations. EPS, if you present additional earning per share amounts based on IFRS subtotal or MPM, they must be in the notes and follow IAS 33 rules. Now, statement of cash flows, what's different? Indirect method must start from operating profit, yes. Remove old options for classifying interest and dividends. Dividend paid financing for all entities. For entities without a main business of investing in assets or providing financing to customers. Interest paid, financing, interest, and dividends received in investing. For entities with a main business of investing in assets, means addition of PPE or providing financing to customer. Classify interest, dividend received, and interest paid by reference to their classification in profit or loss, but present the total of each in one cash flow category. Policy choice may be needed. Then you have to think their specified head. Apply the same aggregation, disaggregation, and labeling principles. Now, this standard is more focused on the labeling. Statement of FP financial position, add goodwill as a separate line item. Third, statement of financial position is presented only when a retrospective restatement reclassification has a material effect on opening balances. Now, title, structure, and moved requirements. You can use alternative titles like balance sheet or net income. Some IAS-1 requirements were moved to IAS-8, retitle. Look, it just retitle. Basis of preparation of financial statement, fair presentation, going concern, accrual, matching accounting policy. To IFRS 7, portable instrument, which I have discussed in the IFRS 9 lecture. Now, real life style case studies end to end. Case A, auto manufacturer, no customer financing business. Okay, no customer financing business. Facts. Alpha Motors makes car, means manufactures car, has bank loans, cash on deposit, some FX means foreign gains on USD raw material, payables, no associates JVs. Means Alpha company manufactures cars, they have a loan, they have no cash deposits, also they have foreign gain on USD raw material, no associates or joint ventures. Now, PL classification, operating, revenue, cost of sales, R&D, selling, admin, FX differences on trade payables. We covered this line regarding the foreign exchange. And inventory purchase, impairment of PPE, inventory write down, depreciation, amortization, employee benefit, if any. Investing, interest and dividends received on term deposits, and investment securities, gain losses on sale of surplus land, if any. Financing, interest expense on bank loans, unwinding of discount on provision, interest on lease liabilities, FX differences related to borrowings. From cash and cash equivalents, interest income on overnight cash balances presented here if required by the standards. split between from financing activities and from cash and cash equivalents. Subtotals operating profit before financing and income taxes profit. So this is how you have to do the P&L classification if the case related to like this. Now operating expense presentation by function disclosure in OneNote, totals for depreciation, amortization, employee benefit, impairment, and reversals. Inventory written down and a qualitative description of what each function includes. Cost of sales includes the total inventory expense per IAS-2. Cash flows. Starting point operating profit. Interest paid, financing, interest and dividend received, interest, investing, dividends paid, financing. MPM example in the notes, adjusted operating profit excludes restructuring cost and a one-off environmental fine, one-off event. Provide full reconciliation plus tax and CI effects if any. Impact more comparable operating profit, cleaner separation of financing effects. Investors see precisely how you adjusted performance and tax effect of each adjustment. Now there are three more cases for your reading. After that, we have we have a FAQ and tricky areas like what are the questions. Maybe you guys have some questions in your mind, so for that you can read it. Now we have a conclusion. Again, we have a visual. Okay, guys. This slide contained 9 to 10 slides. So it's not necessary that you can complete, read, and understand each and everything. Look, the examiner will not go into much detail for this time. But maybe once we move to the next stage or the next year, then the examiner might get into more detail. But for the time being, you don't need to worry at all. Most of these students were just overwhelmed by how IFRS 18 will be tested. Still, if you guys facing any issues in understanding the IFRS 18 content, or if you want me to upload or explain questions on the IFRS 18, then what you have to do, you just have to comment down our question. I will record a separate video on the questions which might be tested in the SBR and F7. So take care, best wishes, and goodbye.